All right, well, what we're going to do now is we're going to take a brief look at the spreadsheet that we completed last Thursday night on partitioning the internal rate of return. Remember that what we're trying to accomplish when we are partitioning or separating or dividing aspects of the internal rate of return is we are trying to determine what percent of the IRR is coming from our operating cash flows versus what percent of that IRR is coming from cash flows from reversion. And so what we want to do is we want to kind of discount those future values back to a present value, sum them up, and come up with a ratio. It's very straightforward, very simple, once you understand how to basically set up the spreadsheet. So let's take a look. All right, what we have here is basically the spreadsheet that we put together at last Thursday's class. We said that we're going to invest in some opportunity that requires a $200,000 cash outlay initially. We also said that there were going to be 5 operating cash flows. We're going to hold this property for 5 years. And we also said that at the end of that 5-year period, we're going to dispose of this property. And we're assuming that we're going to net $250,000 from that disposition. As you know, what we do is we add all of these cash flows up. We simply throw on an IRR calculation for these cash flows in order to determine what that internal rate of return is. Then the next step is to simply diagram out the operating cash flows here, right? We've got them in horizontal form here. Right now, I'm going to put it in vertical form. I think it's just an easier way to kind of visualize how these ratios are working. So we add up all of these future values have now been discounted back to the present value. For example, let me show you how to do one here. If we wanted to figure out the present value of this future value cash flow, our rate by which we're going to discount is the internal rate of return. The number of periods here is we're 1 year out, and the future value that we anticipate getting is $25,000. Therefore, this future value is $20,493. Now, what I typically do is I will multiply these by -1 in order to return these as positive numbers, right? It's not going to matter in the whole scheme of things, but I just like to kind of visually portray these as positive numbers because they are actually positive cash flows here out into the future. All right, so what we do is we discount all of the operating future value cash flows back to a present value by using the internal rate of return as the discount rate. Then what we do is we add up all of these discounted future values here. These are all now in present value form. We add these all up to get the total of these present values from the operating cash flows. Then we take the future value of 250, we discount that back by the internal rate of return, right? To get this present value of this 250 5 years hence. So what I do is then I just simply add up these two numbers, right? This is the sum of these operating cash flows discounted back. And then of course, this is just referencing this other future value cash flow for the reversion discounted back to present value. I add these up. These by definition should equal our initial cash outlay. Why? Because we've discounted these future values back by the internal rate of return. And we said a week or two ago that the net present value, the internal rate of return is in fact the discount rate, which causes the net present value to equal 0. Therefore, we have a -200 here going out. We have a total 200,000 of future value discounted back to present value. So in the aggregate, those present values equal 200. So -200 plus 200 would equal 0. Therefore, we've just proven that the IRR is the discount rate that causes this net present value to equal 0. Then what we do is we just simply come up with a basic ratio. And so what I want to do is I want to take this operating cash flow divided by my $200,000 total. Okay, you see that? That's going to give me a 53.73%. Then I take the this future value of 250 discounted back by the 21.99 for a 5-year hold is going to give me 92. So then what I do is I simply take my 92 and I divide it by the 200 to get 46.27. These two percentages should always equate or equal 100% in the aggregate. All right. So what does this mean? This means that my operating cash flows total 53.73% of my internal rate of return, meaning that this appears to be a very balanced IRR. We're getting about half of our internal rate of return from the operating cash flows and about half of our internal rate of return from the net cash flow at reversion. This is therefore not a very risky deal. Real estate investment always has some inherent risk, but what we try and do is we try and minimize that to the best extent that we can. So in this regard, this appears to be a fairly balanced internal rate of return. Let's take a look at this one, though. This appears to be quite skewed, as you can tell. We've got $100,000 out in the beginning. We only have $1,000, $2,000, $3,000, $4,000, and $5,000 of before-tax cash flow from operations coming on these, coming through these subsequent years, 1 through 5. But here at the end of the deal, we are saying that we're going to net $250,000 from this sale. Well, if we take the same format that we did up here, and we apply that format to this series of cash flows, what we see here at the end of this is that only about 7.5% of our internal rate of return is coming from the operating cash flows. As you can clearly see, these operating cash flow amounts are quite low. But compared to the operating cash flows, my net disposition cash flow is much, much greater. Therefore, my internal rate of return, 92.5% of that, almost all of my internal rate of return is coming from the very end of this deal, thus creating a very risky scenario, right? The return here isn't bad. Call it 22%, but 92% of that is coming from the end of the deal. Now remember, we said the further out into the future we go, the less reliable or more risky these cash flows tend to be. The cash flows in the very early years tend to be fairly predictable, but the sale amount, who knows what's going to happen to cap rates at the end of year 5, or what might be happening to interest rates or other factors of the economy that might impact this net cash flow at the end of the deal. So these internal rates of return are exactly equal. I did that by design to show you which investment would you prefer. The internal rates of return are the same, but this particular investment scenario is much less risky than this one because this is a very balanced asset, kind of cash flows. Half and half, essentially, of my internal rate of return is coming from operations and reversion. This particular deal, though, this particular series of cash flows is way, way more risky because only about 7.5% of our internal rate of return here is coming from the operating cash flows. This is 5 years out into the future, and who knows what's going to happen. So there you have it, folks. This is a very basic scenario of how to partition the internal rate of return in order to essentially quantify our risk portfolio based on operating cash flows and the cash flow from reversion. I'm hopeful that this video has been helpful to you.